This week in the markets, three major stories took center stage: jobs, inflation, and the relentless march of artificial intelligence. Each tells us something important about the US economy and your finances. They have a direct line to your paycheck, your shopping, and your investments. Let's break each down. The latest jobs report from the Bureau of Labor Statistics painted a picture of resilience. The US economy added 210,000 non-farm payrolls last month. Hiring was broad-based, from small shops to multinational campuses. That steady job creation signals continued demand for labor across sectors. The unemployment rate held at 3.7%, historically low. Average hourly earnings rose 0.3% month over month, 4.1% year over year. Wage growth helps households but can also add to inflationary pressures. Participation ticked up to 62.9%, still below pre-pandemic levels. Growth showed up in healthcare and professional services, with firms still hiring. Bringing sidelined workers back could ease shortages without big job losses. Overall, the jobs report shows strength, but the details matter. The jobs report isn't just for economists. It affects everyday decisions. For workers, a tight labor market means more leverage when negotiating pay and benefits. It can translate into better raises, more options, and improved work-life balance. Job security influences major life choices: home purchases, renovations, vacations. But the Fed watches wages closely. Strong labor can mean higher interest rates. Higher rates can cool housing and business investment, raising borrowing costs. Too hot or too cold a report can spook markets. The Goldilocks outcome matters. This week landed near that sweet spot for now. All eyes turn to the Consumer Price Index this week, the government's key inflation gauge. Headline: CPI rose 3.6% year over year, a slight reacceleration from summer. The uptick was driven in part by higher gasoline prices. Economists focus on core CPI, which excludes volatile food and energy. Core CPI rose 4.1% year over year and 0.3% month over month. Service costs, especially housing, remain the main culprit behind sticky inflation. Many goods, like electronics and used cars, have eased as supply chains normalized. Improved supply has helped goods prices fall. But persistent service inflation is the Fed's central challenge. Their target remains 2%. The Fed has already tightened policy. The question is whether more hikes are needed. The path back to 2% is likely to be bumpy. Inflation affects the prices you see every day: groceries, utilities, rent. A basket that cost $100 a year ago now costs about $103.60 at 3.6% inflation. Over time, inflation silently erodes purchasing power. If your savings earn 0.5% while inflation is 3.6%, your real return is negative. Higher interest rates have pushed mortgage costs far above recent norms, squeezing prospective buyers. Car loans and credit card rates have risen, making monthly payments heavier. Higher inflation often pushes investors toward assets that can outpace price growth, like stocks or real estate. Those options can offer protection, but they bring their own risks and volatility. Avoid impulsive moves. Consider risk, diversification, and time horizon. The key is informed choices to protect purchasing power over time. Away from jobs and CPI, the AI gold rush kept pace. Capital is flowing into AI infrastructure. A leading chip maker announced a $10 billion investment in next-generation AI processors. That move signals immense capital building out chips, data centers, and cloud capacity. Tech stocks with AI narratives saw sharp gains this week, fueling the Nasdaq higher. AI-focused ETFs reported massive inflows. Illustrative funds saw roughly 20% AUM growth. Both retail and institutional players are seeking exposure to the theme. Chip makers, cloud providers, and software firms are direct beneficiaries. Those expectations have driven sky-high valuations for some companies. Risks remain: hype cycles, priced for perfection valuations, and the specter of a tech correction. Regulatory scrutiny is increasing. New rules could reshape profitability and business models. AI is a transformative narrative, promising big gains but requiring disciplined risk management. AI is already a daily tool for many designers, developers, and marketers. Developers use AI assistants to write and debug code faster. Chatbots handle routine questions, freeing humans for higher-value work. The boom creates demand for new skills: prompt engineers, AI specialists, and data workers. But automation risks displacement in repetitive, data-driven roles. That raises difficult policy questions about retraining and social safety nets. Data privacy and algorithmic bias are central ethical challenges as AI embeds in daily life.
As one market analyst said, AI is reshaping capital flows, but its ultimate test will be how it reshapes labor.
The challenge: innovating while creating broad-based prosperity. Market Snapshot. Investors digested mixed economic signals this week. The S&P 500 gained roughly 0.8% for the week. The Dow finished nearly flat. The Nasdaq outperformed, up about 1.5%, led by AI narratives. This divergence highlights a market leaning into technology. The strong jobs print nudged bond yields higher early in the week. Interest rate-sensitive sectors, utilities and real estate, ended lower. Banks were mixed. Potential loan profit from higher rates, but risk if growth slows. A handful of large tech firms are disproportionately driving index gains. That concentration raises the risk of sharp market moves if a few names stumble. Investors should monitor concentration risk and maintain diversified plans. Looking ahead, next week's calendar is full: PPI, retail sales, and key earnings. The Producer Price Index will be watched as a potential leading indicator for consumer inflation. Consumer sentiment updates will show whether households feel confident enough to spend. Major banks report next week. Their commentary on lending and delinquencies will be telling. Watch for any new corporate AI initiatives or guidance that could move tech names. A practical step: review portfolio allocation. Tech exposure may have grown larger than intended. Consider trimming oversized positions and reallocating to underweighted sectors. Diversification and risk management remain the core of a durable strategy.